we in uncertain times? What do you think the actual health of the economy is?
Man, leading off.
We're going straight in.
We're going straight in.
We're going kill shots.
Well,
only.
I think the one certain thing we always say in life is there's going to be uncertainty. So I think the reality is there's always going to be uncertainty. Markets are like that. You know, being in this business for 2 decades, I mean, I've been through 4 or 5 presidents. We've been through 3 or 4 recessions, some short, some long. We just went through one of the longest on record 3 years ago, bear market. I would say price to earnings multiples right now, if you look at across the board, the S&P 500, they're trading higher than what we'd like. You typically like them 16 to 18. They're low 20s, depending on what you look at right now.
So what do you do in that scenario? If you feel like it's out of whack, are you not buying, or is there new metrics to look at? Because so much of it now is baked into tech growth, right? Do you feel like the market has a good grasp of how these things should be valued? Is it frothy? AI's following, and that feels like a bubble coming.
I think this is going to sound so, as a financial advisor would sound, but you diversify, all right? You diversify throughout. It's just what you do, okay? It's time in versus timing always. So I think that's really important for everyone to hear and understand. I have been preaching on our show for the past couple years in particular, because for many, many years in my career, and like yours, the S&P 500 had about 10 to 12% of concentration. Now we're up at 40 with 7 to 10 companies. That's important to understand for people when they consider it the broad market. Like, that adjective bugs me nowadays.
Because it's not as broad as you thought.
What's the broad market doing? Let's go look in the S&P 500. Is it really that broad? Because it's made up of 10 companies, right? Netflix, Amazon, Apple, you know them. And so it's hard for me to sit here and say, so we own a lot of those companies, the Magnificent Seven. As our firm, we own a lot of them. We don't own every one of them. They are good investments. Some of them have high price to earnings multiples, which you can consider maybe a little expensive. But again, you sector rotation out of it. You have diversification internally. I mean, all the things any advisor should be doing.
So you're saying that maybe the S&P 500 is not enough diversification for you now?